Right friends, welcome back to questions and answers. This is module number 15 and I would like to give a brief explanation because we have covered most of the concepts under lecture part and these questions we are going to discuss in brief. India agreed to OECD's action plan of base erosion and profit shifting. What is OECD? Organization of Economic Cooperation and Development. This is a Paris-based organization. It is intergovernmental organization primarily intended for economic cooperation among various countries. And now there is a serious discussion with regard to BEPS. What is BEPS? BEPS is base erosion and profit shifting. What is the meaning? The multinational companies, what they will do is, they will earn most of the income from countries like India. They will earn most of the income from countries like India and ultimately they will shift this income to some low tax countries and big countries are losing this revenue. That means they will not pay tax here and they will pay tax in some low taxation countries. That is base erosion and profit shifting, and nowadays governments are serious about this base erosion and profit shifting. The storehouses were banknotes stocked on behalf of Reserve Bank of India. On behalf of Reserve Bank of India, this currency chests are maintained. This currency chest is the storehouse where banknotes are stocked on behalf of Reserve Bank of India. Some bank will maintain it on behalf of Reserve Bank of India. And at present, RBI has got 19 issue offices maintained by RBI itself. They are mostly situated in the capital cities of various states. Then 4,132 currency chests. They are maintained by various banks on behalf of Reserve Bank of India and 3,813 small coin depots, right? So, when someone says currency chest, that is the prerogative of Reserve Bank of India, but some bank will maintain it. RBI made operational CFR. What is CFR? CFR is a Central Fraud Registry. Recently, RBI has made operational this Central Fraud Registry and it is a searchable database and it is centralized and banks can access it and banks will get advantage because of the reason with this centralized database banks can analyze before giving loans, right? RIDF was created. What is RIDF? RIDF is a Rural Infrastructure Development Fund. This was created during the year 1995-96. If banks have shortfall in lending to priority sector lending, that shortfall is to be deposited to RIDF maintained by NABARD and in turn this money is given by NABARD to various state governments to develop medium and minor irrigation projects, soil conservation and watershed management projects, right? If banks have shortfall in priority sector lending, all of you are well aware, 40% is the priority sector lending target. If banks fail to ensure that 40%, the shortfall is to be credited to Rural Infrastructure Development Fund maintained by NABARD. Banking Ombudsman scheme was in vogue since 1995 and it is operated by Reserve Bank of India and recently Reserve Bank of India gave instructions for some banks to establish their own ombudsman or you can say internal ombudsman popularly known as CCSO and all the public sector banks and certain private sector banks and certain foreign banks operating in our country are required to establish CCSO. CCSO is internal ombudsman and this external ombudsman is appointed by Reserve Bank of India. Interest subvention scheme for crop loans to farmers was introduced in 2006-2007 financial year and this interest subvention scheme is basically intended for crop loans to farmers. We have already deliberated in detail about this during the lecture part. Which of the following is not related to lending activity of the bank? Here 4 terms are given. First and foremost is benchmark prime lending rate that came into existence in 2003. Then base rate that came into existence in 2010, and by replacing base rate, this marginal cost of funds based lending rate or MCLR will come into existence from 1st April 2016. So, these 3 are the benchmark rates, one came after the other, and from April 1, 2016, MCLR will be in operation. So, base rate, BPLR, MCLR pertain to lending activity of the banks, but cost of funds is not related to lending activity. Cost of funds is related to deposits. That is the average interest rate which the banks are required to pay to the depositors. Which of the following entails a high interest? And junk bonds. Junk bonds are the bonds issued by the companies which have very low credit rating. They are not reputed companies. If such type of companies issue bonds, they are called junk bonds. So, junk bonds will carry higher interest. Out of the given, junk bonds will carry the highest interest, then debentures, then public sector undertakings bonds, then government securities. So, what I mean to convey is government securities, because of sovereign in nature, because of the highest security, will carry the least interest, followed by public sector undertakings bonds, then debentures issued by the private sector companies, then junk bonds issued by the companies which have less credit rating. So, wherever risk is involved, interest rate will be more. Wherever risk is less, interest rate will be less. That is the fundamental theory in the banking system. And please do not forget this fundamental theory. Which of the following does not pertain to bonds? Yield and coupon rate pertains to bonds. Coupon rate is the interest rate on bonds, and once the bonds are issued, then these bonds are liable for resale, and once these bonds are sold for less or for more, then the subsequent interest calculated is known as yield. So, yield and coupon rate are the terms associated with bonds, but dividend is associated with shares. So, if someone says shares, dividend you should not forget. And if someone says bonds, please don't forget yield and coupon rate. So, yield and coupon rate are the terms basically pertain to bonds. Dividend is the term pertains to shares. Which of the following is not a fixed income security? Fixed income security means you should get the stated interest, and government securities, you will have fixed interest. And corporate bonds, when corporates are releasing bonds or debentures, then the interest will be stated in advance. So, these are fixed income securities, but shares, they are not fixed income securities. The value or the returns on shares depends on market conditions. Shares may give higher profit, or sometimes they may go into losses. It all depends on the market conditions. So, shares is not a fixed income security. Why banks participate in call money market? The interesting question here, banks participate in call money market because to take care of temporary mismatches of funds. No one knows how much money banks are going to get on particular day and how much money banks are paying to its depositors on particular day. They cannot anticipate in advance. That's why this call money is required by the banks to take care of temporary mismatches of funds. Second is, they have to maintain CRR and SLR requirements on day-to-day basis, particularly CRR, because SLR normally banks maintain in the form of government securities. So, to maintain CRR at present it is 4%. So, to maintain 4% on day-to-day basis, they require some cash. And third one is to meet sudden demand for funds arising out of large outflows. So, these three are the valid reasons for the banks to participate in the call money market. Which of the following is or called very short term money market instruments? This call money and repo. When banks borrow from Reserve Bank of India on repo rate, that is for short duration, and call money, this is also for very short duration. So, out of the given options here, call money and repo transactions are categorized as very short term money market instruments. So, the answer here is 4, that means both 1 and 2. Which of the following is not regulated by SEBI? Here 4 options are given. SEBI is Securities and Exchange Board of India. First one is bond market. Normally bonds are issued by public sector enterprises, and this bond market is regulated by SEBI. Second is corporate debt market. When the corporates or companies are issuing debentures for taking loans from the market, that is corporate debt market, and that is also regulated by Securities and Exchange Board of India. Then mutual funds. All of you are well aware, mutual funds means they will pull up money from small investors like you and me, and subsequently they will invest in stock market. So, this mutual funds is also regulated by Securities and Exchange Board of India, and government securities is the prerogative of Reserve Bank of India. Please don't forget, government securities are regulated by Reserve Bank of India. Which of the following comes under the purview of Reserve Bank of India? First one is issue of government securities. Government securities, the money will go to central government, but Reserve Bank of India will act as the intermediary while issuing government securities. So, this issue of government securities is within the purview of Reserve Bank of India. Second, money market instruments. Most of the money market instruments like certificate of deposits, like commercial paper, like call money market, all these are regulated by Reserve Bank of India. So, if someone asks what is the regulator for money market instruments, that is Reserve Bank of India. Third one is government's market borrowing program. Government's market borrowing program is taken up by Reserve Bank of India by issue of government securities. By issue of government securities, Government of India will get money, that is the government's market borrowing program. So, 1 and 3 almost one and the same, right? So, all the 3 given options, they are within the purview of Reserve Bank of India. So, if someone says market borrowing program, if someone says government securities, if someone says money market instruments, that all comes within the purview of Reserve Bank of India. Please don't forget. Which of the following carry lower interest? Here you see debentures. Debentures are normally issued by companies. Then public sector undertakings bonds. The interest rates on debentures will be higher. Then public sector undertakings interest rates will be lesser than that. But if government allows tax-free bonds, the interest will be still less. Why governments allow tax-free bonds? Governments allow tax-free bonds with some particular purpose, like electrification, like going for acquisition of assets in railways, for development of highways. Under those circumstances, government may go for tax-free bonds so as to give impetus to infrastructure sector, so as to give impetus to other desired sectors as government feels from time to time. So, this tax-free bonds will carry lesser interest because the persons subscribing to tax-free bonds will get some income tax benefits. Right, friends, look at the next one. Why the government securities are called gilt-edged securities? The government securities are called gilt-edged securities because of the reason due to sovereign guarantee. The particular government is giving guarantee. If I am subscribing to government securities of India, then Indian government is guaranteeing me that it will take the responsibility of paying back to me. That's why they are called gilt-edged securities. Which of the following cannot be transferred? This fundamental question, please don't forget, fixed deposits cannot be transferred, but debentures, shares, bonds, these can be transferred, but fixed deposits cannot be transferred. This is the fundamental thing, please don't forget. In the banking system, which of the following is with a view to solve the problem of distress in loans? If loans are about to fail, if loans are going into default, what are the mechanisms devised by Reserve Bank of India? First one is Joint Lenders Forum. Before the loan becoming non-performing asset, that is at the stage of SMA 2, Joint Lenders Forum is to be constituted. This is with a view to ensure that the loan should not go into default. Second is SDR, Strategic Debt Restructuring. What is this strategic debt restructuring? Through strategic debt restructuring, banks can acquire ownership in companies. Third one is CDR, Corporate Debt Restructuring. Under this mechanism, the loan schedule can be revised. So, these three are the mechanisms to solve the problem of distress in loans. In business parlance, which of the following is termed as weak in its formation? The weakest is the single proprietorship firm, then partnership firm. These two are the weakest entities, but private limited company, public limited company, limited liability partnership, they have to follow the rules and regulations of corporate governance in this country. So, these three firms, private limited company, public limited company, limited liability partnership, they have very good corporate governance structure, but a single proprietorship firm and the second one is partnership firm, these are the weakest entities in any business parlance. In India, which of the following does not entail subsidy? In India, there is no subsidy on diesel, there is no subsidy on petrol. We have to pay the market price, but there is a subsidy on LPG, which we are getting through DBTL or PAHAL. There is subsidy on kerosene. There is subsidy on fertilizers, there is subsidy on food. So, these things please don't forget, we are getting subsidies on fertilizers, on food, on LPG, on kerosene, but there is no subsidy on diesel or petrol. Lala Lajpati Rai is associated with the formation of Punjab National Bank, and this Punjab National Bank was born in the year 1894. In CREDAI, E means estate, CREDAI means Confederation of Real Estate Developers Association of India, which was established in the year 1999. So, the answer here is estate. Which of the following is or refinance institution? Whatever I have mentioned, these are all examples of All India Financial Institutions or popularly known as AIFIs, and these are Exim Bank, it is a refinance institution for promoting exports. NABARD, it is a refinance institution for promoting rural development, which includes agriculture. NHB, this is National Housing Bank, it is fully owned subsidiary of Reserve Bank of India and it is basically for giving refinance to housing sector. Then SIDBI is basically to promote MSMEs to give refinance. So, these are sectoral development finance institutions or All India Finance Institutions, or you can say refinance institutions. So, the answer here is all are refinance institutions. Look at the last one, which of the following is not considered as a debt instrument? Here, if you look at the options, first one is bonds, that is a debt instrument. What is debt instrument? You have given loan to some company, company will give you bond or debenture. This is known as a debt instrument. So, bonds, debentures, these are examples of debt instruments. Not only that, money market instruments are also debt instruments. They carry some rate of interest, but shares is not debt instrument. Shares is example of equity instrument, but remaining three are examples of debt instruments. Right friends, with this let us conclude the module 15 and Module 16 may be there after a month or so, because I have already told you this will be extended as and when some new questions are developed in course of research at Learning Space. Right friends, have a nice day. Thank you.